No excuses, see it through.
ADA, what does that stand for? That stands for the Americans with Disability Act. And how does that relate to commercial real estate, specifically for shopping centers? Is that the shopping centers that you have, if you're in operations, you always have to pay attention to make sure that, to the best of your ability, or I think it's to achievable standards, that you can keep your property at whatever the current ADA standards are. And what that is that it has to be accessible by people in wheelchairs and with other handicaps. So when you have a ramp to get from one level to another, it has to have no greater of a certain amount of incline or a slope. There needs to be certain handrails. The bathrooms have to be a certain size so that wheelchairs can turn around. And a lot of those other requirements, I think signs themselves have to be posted and of a certain height, or no greater than a certain height, or no less than a certain height, etc. There's a lot of professional services that can evaluate your property to figure out if you are in ADA compliance or not, and if you're not, what you can do to try to remedy it. In some cases, with very old properties, it's just not readily remedied unless you knock down the whole property and build new. So I think there are some accommodations if it's just impossible to achieve. So that's ADA. You'll also hear that there's been a lot of what you call ADA lawsuits, where there could be like one single attorney that just goes down an entire busy street and sues every single shopping center on the street in a systematic way, and that's a bit of an issue in the state of Florida, where it's not really achieving the intended outcome there. And so that is something that I think is getting probably discussed, and hopefully there's a fair remedy at some point. LLC and Inc. What do they stand for? Limited Liability Company and Corporation, or Incorporated. So what does that mean in terms of retail leasing and commercial real estate? It's really thinking of it specifically from leasing. You have to think of it as that's usually the entity that's signing the lease or guaranteeing the lease. And when you're looking at LLCs and Incs, you have to look at them a little bit differently, in that oftentimes LLCs can be a pass-through entity, which means that there's many cases where there might be a tenant with 20 locations, but each location is its own LLC. And then that income's passed through to the parent corporation, which is usually a corporation. And so when you have an LLC as a entity for the tenant, you want to be maybe a little bit more, you want to look a little bit closer to find out what assets that LLC actually has that's guaranteeing the lease, how many other locations is under that LLC, etc. Or more often, Inc. You might have, multiple locations all under that corporation. And also there's, from an accounting standpoint, which I won't really get into, there's key differences between LLC and Inc., as well as shareholders and things like that. So, but just for leasing, I think that when you see LLC, just make sure that if it's a single location LLC, you're getting a strong guarantee coming behind that. If it's an Inc., you also have to get the financials, but it's more likely that it's going to be a stronger entity. And that's my 2 cents on it. SNDA, that stands for Subordination, Non-Disturbance, and Attornment. This is a legal document that is a part of a lot of the loan docs of landlords when they go and borrow money to buy or refinance a property, including a shopping center. And the reason why that's there is because the lenders want to make sure that all of the leases of the shopping center or the commercial property are subordinate to the mortgage. That the mortgage has first lien rights, and that's very important for the lender, because if they don't have that, you're definitely not getting a loan for the property. The tenants know that, the landlords know that, so it's a very common document to have as part of the lender docs. But also within the lease, there are things that can be written in the lease that make the lease automatically self-subordinating. But if it's not in there, a lot of the tenants understand that they will have to sign an SNDA if presented one, as long as certain things are met, which is that they can subordinate their lease, but that they're not going to be disturbed, or they're not going to be kicked out of their lease in the event that the lender or the property owner defaults on their loan, and then the lender has to come in as the property owner and manages it for a period of time. And that's kind of where the SNDA kicks in. So the worst case scenario is that the landlord or borrower from the bank defaults on the loan, and then the bank has to foreclose and come in and act as the new owner of the property for a period of time. Well, if you have the SNDA in place, the tenants know, look, my lease is subordinate to the mortgage. The bank coming in is my new landlord. I send the rent to the bank, and that the lender cannot change the terms of my lease unilaterally. So it offers the protection both ways, and that's what it is. I'm kind of describing it from a non-attorney, non-banker point of view, but that's essentially what the SNDA is. Thank you. IRR. It stands for Internal Rate of Return, and it's a term that is used very often in commercial real estate, especially our industry, the shopping center industry. And it's used probably more often in both asset management and in capital markets, maybe a little bit less often in leasing, but it's very important to know how it plays into the investment in leasing to help you structure deals better, or to just understand why certain deals get approved and certain deals don't get approved, or why the owner or the asset manager is asking for a little bit of modification of the terms of the deal. Essentially, what IRR is it is the annualized rate of return for all cash flows over a period of time, meaning all the money that you put in, which is negative cash flow because you invested money, and all the money that you get out, which is positive cash flow over a period of time. And it can be 3, 5, 10 years. Oftentimes for capital markets, they're looking at it either at a 5-year or a 10-year horizon. Sometimes when you work with these companies that are buying and selling very quickly, maybe they're looking at it over a 2 to 3 year horizon. So I can probably get in really deep into this, so I'm not sure if I want to or not on this video, because I could probably do a whole video just on IRR. But I've heard one way to put it is that the IRR is, remember NPV that we talked about last video? So that's the net present value. If you were to take the net present value, including the basis, the negative money that you put in, and the residual value, like your sale, if you were to sell the property, your exit value and what you get out, the IRR is equivalent to if the discount rate for that NPV, so that the NPV is 0. So if that makes any sense. So it's a little bit complex. That's why I want to do the own video on it. But in general, a shorter time period is probably going to give you a higher IRR. A longer time period will give you a lower IRR in general. And and also it's kind of like how efficient are you using your money, because it doesn't really measure whole dollar values, meaning that an IRR for a small deal might yield, or a small deal might yield a very high IRR, for example, and you're getting, a very efficient use of your money on a much smaller deal. But a bigger deal for a longer time horizon, you might have a lower IRR, but you're getting a lot more money over that, like actual dollars. You're getting a lot more, but maybe it's a little bit less efficient use of your investment, but you're just getting a lot more money over that time period. Maybe I will get into a quick example on leasing. So if you're looking at leasing a multi-tenant shopping center, you have to understand how your landlord is looking at it, what time horizon, right? And then you have to think of like the residual value, meaning that let's start with that. Like think of it, you have a basis going in. Your property owner invested maybe $200 a square foot to buy the property, and let's say the rent that you're proposing to get across the board for the center is maybe $30 a square foot, for example. If your hold period is 5 years and the exit cap is 5%, for example, then I think that your residual value would be about $600 per square foot. So you bought it for $200, your residual $600, you're getting $30 a square foot along the way. Then the question is, how much did it cost you to get the deal? Maybe you had to invest, $80 a square foot. So now, that's within the cash flow analysis, and there's commissions involved and things like that. So then, what is the IRR on that deal, right? So that's like one example. So IRR, as it pertains to leasing, like the leasing associate, the things that you need to know is that the residual value, or the value of the property when you're about to sell it, that's very important. Like, because you have your rent, like let's say it's $30 a square foot, but then what is the exit cap rate, right? Is it 10%? Is it 5%? Is it 7%? And you're wondering, well, how do people determine it? It really is a couple of things. It's the quality of the tenant itself, like how attractive is the tenant in financials and their history operating at the property. How much do they invest into the space itself? Like, what's the likelihood that cash flow is going to remain solid for the next 10 years after when you go and sell the property? So if you're selling, if it's Chick-fil-A, like I don't think there's been a Chick-fil-A that went out of business, or very few. So they're like, wow, this Chick-fil-A is locked in. But if you're selling an Office Depot, maybe there's been a lot of Office Depots that close, so that income stream's a little bit less steady or less secure. So that's your exit value. So when your landlord pushes you on the quality of the tenant, he's probably thinking, well, what's the value of is the value of my property when I go exit the property, and what cap rate can I use to capitalize that income? Because that's a huge swing of it. The stuff that happens in between, you're getting $30 a square foot. That's very good. Also, that's your yield, which I'll talk about in a future video. But also you got your exit value, the rent in between, and then in the beginning you have your build out cost, your leasing commissions, your downtime, and then what you actually paid for the property. And what you paid for a property is probably the biggest number, which is why they say that you make your money when you buy the property. But also what you're investing in the property, that's like adding to your basis essentially, because it's just more of a negative number. And that's why landlords are often just really pushing back on really big TI dollar amounts, unless, you know, they plan on recapitalizing it very quickly, meaning like refining and taking it back out or selling the property or something like that. Anyway, this it can be a huge topic. I'll do my own its own video sometime in the future after I do the answer key series, so look out for that. Thanks for watching. This is Hugh Chen. I have been in commercial real estate for 25 years, specifically in the retail asset class. Happy to share my learnings and, you know, try to bring awareness to retail leasing and the shopping center industry. This is part of the Answer Key series, which is a tool for my leasing agent proficiency test that I have posted on my LinkedIn. So the Answer Key will help you figure out, you know, what each of the terms on the leasing agent proficiency test mean. All right, I'll talk to you later.
It's more than the deals, it's the face-to-face, the little convos that change your pace. Find a mentor, sparking out.